Welcome to the Research Desk.
Glad to be here.
So today is March 17th, 2026, and we are examining a structural paradox that it's really currently defining the upper echelons of global equities right now.
It absolutely is.
Yeah, I want you to imagine a company whose core operational engine is actively and measurably shrinking. Its top-line revenue is contracting, its profits have been cut by more than half, and its once dominant operating margins have collapsed down to the low single digits.
Right.
Yet, on the exact other side of the ledger, the broader market has assigned this exact same enterprise a staggering $1.48 trillion market capitalization. We are, of course, analyzing Tesla. Now, my framework today approaches this intense divergence not as some systemic market failure, but really as a transitional chrysalis phase.
This enterprise possesses the immense cash reserves, the proprietary data moats, and, frankly, the sustained narrative power required to bridge the gap between its legacy automotive operations and its future as the world's premier AI and robotics platform. That's the thesis.
Well, I look at the exact same data set, and I arrive at a fundamentally different conclusion. What we are witnessing is not a chrysalis, okay? It is the market stubbornly mispricing a maturing automotive cyclical as a hyper-growth technology monopoly.
You really don't see the tech premium is justified at all?
No, I really don't. The market is ignoring a very, very dangerous reality. It's eagerly capitalizing these distant, mathematically unproven promises of autonomy and robotics, while the core mechanical engine that actually has to fund that future is actively degrading. We are testing the absolute limits of financial gravity here.
Right. Well, that tension between the undeniable degradation of the present reality and the massive, platform potential of the future is exactly what we are going to unpack today. To do that systematically, we will follow the analytical slide deck we have in front of us. So let's just begin with slide 1, which outlines the key performance metrics and perfectly establishes our central tension.
Let's do it.
The stock is currently trading at $395.56. Walk me through the fundamental picture as you see it, because the raw numbers here present a very specific narrative.
Yeah, the narrative those numbers present is a localized collapse in operating performance. When we actually strip away the AI rhetoric, right, and just read the raw automotive metrics, the picture is incredibly stark. Trailing 12-month revenue currently sits at $94.8 billion. Crucially, that represents a 3.1% decline year over year.
Right, a contraction.
Exactly. We need to be precise with our language here. We are not talking about a deceleration in the rate of growth. We are talking about absolute negative growth. The pie is shrinking. And following that reality down the income statement, earnings have plunged by an astonishing 60.6% year over year.
And the margin compression is equally severe.
It's unprecedented for a company of this scale. The operating margin, which was once the envy of the entire industrial world at nearly 17% just a few years ago, has been crushed down to a mere 4.6%. Net margins are sitting at 4.0%.
Wow.
To put that in perspective, those are the basic economics of a legacy metal bender struggling with intense pricing pressure. That is not a software company. Yet, the valuation paradox on this very same slide tells a completely different story.
Yeah, lay out the valuation multiples, because this is where the mathematical disconnect really occurs.
The disconnect is historic. We have a company shrinking its top line and having its bottom line, yet it trades at 337 times trailing earnings.
337.
337. And even if we look forward, giving them the benefit of highly speculative growth estimates, it trades at 141 times forward earnings. We are looking at 15.65 times sales, and perhaps the most glaring metric on the whole page, an enterprise value to EBITDA ratio of 138.6.
Right. And just for the listener, enterprise value accounts for their cash and debt, giving us the true takeover price of the business, and EBITDA gives us the core cash flow.
Precisely, paying nearly 139 times EBITDA for a business that generates a 4.6% operating margin violates the core tenets of corporate finance. You are paying over 15 times revenue for a company that barely keeps 4 cents on the dollar. It's madness.
Well, okay, I see the mathematical friction there, I do. But let me offer a different framework for how we should be evaluating those multiples. Look at the sheer scale of the enterprise listed here on slide 1. We're talking 134,785 employees and a massive, vertically integrated global footprint spanning from Shanghai to Berlin to Texas. We have to ask a foundational framing question here. Are we making a categorical error by evaluating this company using the trailing price-to-earnings metrics of an automotive manufacturer?
How is it a categorical error to measure a car company by the cars it sells?
Because they are actively building the world's largest autonomous mobility and compute network. If the market is valuing the future robotics, the full self-driving software licensing, and the energy storage cash flows, applying a legacy automotive PE multiple is essentially using the wrong instrument to measure the asset. It's like trying to measure the value of a high-speed fiber optic network by weighing the plastic casing around the cables. The market is pricing in the software transition.
That is a compelling theoretical argument, sure, but it requires us to completely ignore the fact that the automotive segment is the sole engine currently funding that software transition. You cannot divorce the valuation from the underlying cash generation engine. The current automotive operations are what sustain the vision. Hold on, let me finish. If the core engine degrades, the timeline to achieve that autonomous future extends. And in finance, when a timeline extends, the present value of those future cash flows must be discounted heavily. You cannot indefinitely fund a $1 trillion AI vision with a business generating a 4.6% margin. It just doesn't work.
Well, that is precisely why we need to understand the structural mechanics behind those margins. If we transition to slide 2, we can unpack the Damodaran four walls framework. And, for the listener, Aswath Damodaran's framework breaks down the viability of a company's valuation into 4 distinct pillars: revenue growth, operating margins, capital efficiency, and discount rates. Looking at the data, you have scored 3 of these walls as flashing red, and only 1 is yellow.
Right.
Let's go through them systematically, starting with the first red wall. Revenue growth. Why is a company that effectively invented the modern EV market suddenly experiencing negative 3.1% revenue growth?
We have to look at the mechanics of the global electric vehicle price wars. The competitive landscape has been fundamentally altered, specifically by the rapid rise of BYD and the Chinese EV supply chain. We have entirely transitioned from a supply-constrained environment where Tesla could dictate pricing because they were frankly the only viable premium option, to a demand-constrained environment characterized by fierce, commoditized competition.
And BYD is achieving that through vertical integration, correct?
Exactly. BYD started as a battery manufacturer. They mine their own lithium, they build their own LFP, lithium iron phosphate cells, and they own their shipping logistics. They own the boats. Because their underlying cost structure is drastically lower, they can flood the European and Asian markets with high-quality, low-cost vehicles.
Right, so Tesla has to respond.
And to defend its market share against this onslaught, Tesla has had to implement continuous, aggressive price cuts. This is the mechanism driving that negative revenue growth. When a company slashes prices to maintain its factory output, they are effectively taking value directly from their shareholders and transferring it to consumers. When your revenue is shrinking despite maintaining unit volume, your growth thesis is structurally broken.
I acknowledge the severity of the price war, but volume defense is a deliberate, strategic choice. Every vehicle Tesla sells, even at a lower margin, adds another camera suite to their global fleet. They are actively expanding the installed base for future software monetization. They are gathering real-world driving miles, which is the foundational training asset for their neural networks. But let's address your second red wall on slide 2, which is operating margins.
Yeah, the operating margin compression from 17% down to 4.6% is catastrophic for a valuation built on operating leverage. I want to point specifically to the Cybertruck as the prime mechanical example of this dynamic. The Cybertruck succeeded brilliantly as a marketing mechanism. It reinforced the brand's cult-like capacity to command global attention. But spectacle is not margin.
Walk me through the actual manufacturing friction the Cybertruck introduced, because I think a lot of people miss the engineering reality here.
The vehicle required entirely new production techniques that broke Tesla's standard assembly line efficiency. They utilized unpainted, ultra-hard cold-rolled stainless steel, which is notoriously difficult to stamp and form, resulting in microscopic panel gap issues and massive scrap rates.
Right.
Furthermore, they transitioned to a 48-volt electrical architecture and a pure steer-by-wire system. These are incredible engineering feats, I'll admit that, but they required Tesla to effectively force their entire supplier base to invent new components from scratch, because the entire global auto industry runs on 12-volt systems. The Cybertruck acts as a halo product that adds tremendous manufacturing complexity while dragging down overall corporate profitability. They are paying heavily for innovation rather than harvesting the profits from it.
Let me stop you there, because the 48-volt architecture is exactly why I view this as a chrysalis phase rather than a structural decline. Yes, moving from a standard 12-volt system to a 48-volt system required brutal upfront engineering costs. But what is the mechanical result? It reduces the electrical current required to power the vehicle's components by a factor of 4.
Right, standard physics.
Right. So that means the internal wiring harness can be significantly thinner, which strips massive amounts of copper weight out of the vehicle. That reduces raw material costs and simplifies robotic assembly. The Cybertruck undeniably impacted near-term margins, but I frame it as necessary foundational learning. They are going to take that 48-volt architecture and apply it to their next-generation mass-market platform, fundamentally lowering their cost of goods sold.
That is the perpetual promise. The pain is today, the profit is tomorrow. But that brings us to the third red wall on slide 2. Discount rates. This is a mathematical danger zone where promises meet reality. We are looking at a price-to-free cash flow ratio of 239 times. We are operating in a structurally higher interest rate environment today compared to the zero interest rate phenomenon of the early 2020s.
Sure.
Applying hyper-growth valuation multiples to a company with declining revenues, while the risk-free rate of return sits at normalized levels, it just violates the basic gravity of corporate finance. The sensitivity of this stock to any further delay in future cash flows is extreme. If the Robotaxi is delayed by even 24 months, the present value of the company mathematically collapses.
I understand the mechanical risk of the discount rate, I do, but this naturally transitions us to the one wall in slide 2 that you've actually marked as yellow rather than red, capital efficiency. And this is the exact foundation where the survival and transition thesis anchors itself. While the return metrics are weak, return on equity sits at 4.9% and return on assets is a mere 2.1%, we must look at the balance sheet. Tesla boasts a $44 billion cash fortress. Their total debt is only $14.7 billion. That leaves them with a debt-to-equity ratio of just 0.10.
I readily concede the balance sheet is pristine. The current ratio is 2.16, meaning their short-term assets easily cover their short-term liabilities, and their interest coverage is nearly 13 times. It is a financial fortress.
Right, and that fortress fundamentally changes the risk profile. Let me offer an analogy here. This cash pile acts as a temporal bridge. It literally buys time. If we look back at the Model 3 production ramp in 2018, Tesla faced a genuine production hell where solvency risk was an existential threat. They were weeks away from missing payroll. Today, that solvency risk has been completely eradicated. This $44 billion balance sheet allows them to fund massive compute infrastructure, to build out the Dojo supercomputer clusters for AI training, and to fund the Optimus humanoid robot R&D programs entirely internally. They can do all of this without ever needing to tap the credit markets or face refinancing stress in this higher interest rate environment.
I completely understand the math, but I reject that as a justification for the current market capitalization. I agree that the balance sheet removes bankruptcy risk, but time is incredibly expensive when your equity is priced at 337 times trailing earnings. A fortress balance sheet guarantees survival. It ensures you can pay your elite AI engineers, secure massive clusters of NVIDIA GPUs, and keep the gigafactories running. What it absolutely does not do is justify a $1.5 trillion premium. Surviving is not the same thing as compound growth.
It justifies the premium if the market views that cash as the necessary fuel to achieve autonomous platform dominance without diluting the existing shareholder base.
But a company with 3 red fundamental walls, operating solely on the grace of its cash pile, implies it is constantly borrowing goodwill from the future. The market is giving them immense financial credit for businesses like humanoids and robotaxis that simply do not exist financially yet.
Well, to see exactly where the market thinks Tesla is in its developmental life cycle, and to measure that goodwill, we need to examine slide 3. This slide unpacks the market and corporate clocks, mapping the temporal alignment or, misalignment between the company's internal development and external market expectations. Let's start with the corporate clock.
Yeah, the corporate clock model places Tesla precisely at stage 4, transitioning to stage 5. In corporate life cycle theory, this is the phase of mature growth attempting a highly complex transition into a multi-product portfolio. The severe danger here is the timing gap. The legacy automotive engine is aging rapidly. We see the very clear symptoms: slowing overall growth, intense Chinese price competition, and cyclical margin compression.
The stuff we just covered.
Exactly. Meanwhile, the new growth engines, specifically the Robotaxi network and the Optimus humanoid robot, remain entirely pre-revenue. They are developmental prototypes. So you have a primary cash engine that is stalling out before the replacement engines have even been installed, let alone started generating meaningful commercial cash flow.
I agree, there is a timing gap, but we also have to analyze the market clock shown on this slide. The market sits roughly at the 4.0 position. This indicates a post-Euphoria correction phase. The stock is currently down 19.3% from its December 2025 all-time high of $489.88.
Right.
That prior peak was driven almost entirely by the AI full self-driving and Optimus narrative, compounded heavily by perceived political capital. The market has already realized a timing gap exists, and the current 19.3% drawdown is the market actively adjusting its expectations.
And that adjustment is precisely why the Cisco 2000 parallel, highlighted here on slide 3, is so critical. This is the most accurate historical analog we have. In the year 2000, Cisco was not a fraud. It was a phenomenal company with brilliant management and pristine engineering. Their strategic vision that the internet would fundamentally transform global communications and require a massive build-out of physical routing infrastructure was 100% correct.
They basically built the plumbing for the internet.
They were the dominant provider of the hardware that made the web possible. Yet the stock absolutely collapsed, wiping out immense shareholder wealth. Why did that happen? Because the market pulled the demands for all that future success too far forward into the present valuation. They priced Cisco as if perfect execution of the future was already a certainty, leaving absolutely no margin of safety for the friction of execution, cyclical macroeconomic slowdowns, or heavy capital expenditure digestion. Tesla is doing the exact same thing right now with the concept of autonomy.
That is a fascinating parallel, but I push back on the underlying mechanics of that comparison. Cisco was selling physical hardware into a one-time global infrastructure build-out. Once the major telecommunications companies installed the routers, the exponential hypergrowth phase ceased. It became a replacement cycle business.
Okay, but
Wait, let me just present the countermodel, which is also on this slide. Amazon's transition to Amazon Web Services, AWS. Think back to the era when Amazon was transitioning from a pure e-commerce retailer to a cloud computing giant. If Wall Street analysts had judged Amazon solely on its razor-thin and often negative retail margins right before AWS matured, they would have called the stock an obvious short. But the underlying server infrastructure was actively being built beneath the surface. Look at Tesla's energy storage segment today. The Megapack deployments are growing at over 100% year over year. Isn't this highly profitable energy business the early, visible signal of a similar paradigm pivot, much like the early days of AWS?
the core mechanics of your Amazon AWS analogy are fundamentally flawed.
How so?
The crucial difference between Amazon then and Tesla now is financial visibility and active monetization. When Amazon was making that transition, Jeff Bezos was using the retail business as a loss leader, yes, but AWS was already generating tangible revenue. Enterprise clients were paying for server space. Analysts could look at the balance sheet, see the line item, and model the software-like margins. AWS was actively monetizing its compute infrastructure.
But Tesla's
robotics and autonomous network are still largely stagecraft. Optimus is currently a highly controlled environment demonstration, not a commercial product available for enterprise purchase. The Robotaxi is entirely pre-revenue. You are asking the broader market to value Tesla like a mature, cash-flowing AWS, when all we have is a theoretical white paper on autonomy.
We have substantially more than a white paper. We have millions of consumer vehicles actively driving on global roads every single day, gathering immense terabytes of real-world edge case video data. That localized video data is piped back into the Dojo supercomputers to train the neural network. No other company on Earth has a decentralized physical data gathering mechanism on that scale. But, your point about the psychological tension of this timing gap is well taken. To see how this exact psychological tension, this debate between the Cisco hardware collapse and the Amazon AWS software triumph, is playing out in real time, we must move to slide 4.
Right.
This outlines the geometric order and the actual price action. The market is voting on this debate every second.
When we look at the geometric order, the signal sits at 1, which indicates velocity. Crucially, the direction of that velocity is firmly downward. The stock is currently trading at $395.56. It is trapped beneath its 50-day moving average of $420.64. More importantly, it is resting incredibly precariously right on top of its 200-day moving average, which sits at $393.45. The sigma distance is 0.09.
Clarify the mechanics of the sigma distance for the listener.
Sure. Sigma distance measures how far the current price has deviated from its statistical mean. A sigma distance of 0.09 means the stock is resting right at the statistical baseline of its long-term trend. The rubber band is completely slack. It is right at the edge of the cliff.
The slide provides a highly evocative analogy for this exact technical posture. Think of Tesla as an aircraft descending through thick, heavy cloud cover toward a mountain ridge. Management is the pilot. They haven't lost control of the aircraft, the engines are still running, and the plane is certainly not in a free fall, but the margin for error has completely vanished. That 200-day moving average at $393.45 is the mountain ridge.
Precisely. And if the landing gear doesn't deploy, meaning if fundamental earnings do not form a solid, verifiable floor beneath the valuation, that ridge will not hold them. The stock's current price is built purely on narrative belief, not on a confirmed earnings yield. If that 200-day moving average fails, we are not looking at a gentle, methodical glide path downward. We are looking at a rapid, violent, multiple derating. When belief suddenly breaks in a stock priced at 337 times earnings, the air pocket below is massive.
I am not convinced by that fatalistic interpretation of the chart, because the long-term trend signal remains officially open. If we trace this exact trend back to its entry date of June 6th, 2025, at $295.14, the current position still represents a positive 34.0% gain. Yes, the retracement from the December peak is 35.2%, but we have to look at the volatility profile. This asset carries a beta of 1.93, meaning it is historically almost twice as volatile as the broader market.
High beta cuts both ways.
True, but in the context of a high beta asset, a 35% retracement that holds the 200-day moving average is textbook market geometry. It is a healthy consolidation shelf. It is a necessary pause for the market to digest the monumental 2025 AI narrative run before it builds the energy for the next platform leg higher.
You call it a healthy consolidation shelf. I look at the declining fundamentals and call it the precipice. If that 200-day support breaks, who exactly is going to step in and catch a falling knife that still trades at over 100 times forward earnings? Traditional value investors certainly will not touch it. It is far too expensive. Growth investors won't touch it because the core revenues are actively declining, which brings us directly to slide 5, which investigates market positioning, specifically the extreme score and short interest.
We need to understand the psychology of who is actually holding this asset right now.
Slide 5 presents what I consider the most fascinating psychological anomaly in the entire data sheet. Look at the short interest metric. It is remarkably low at just 1.85%. Think about the gravity of that. Despite the collapsing fundamental metrics, despite the shrinking margins we discussed on slide 2, and despite the astronomical valuation multiples, the broader market flat out refuses to aggressively short this stock.
Yes, it is an anomaly, and we need to dissect exactly why that is and what it implies for systemic downside risk.
Well, I frame this mathematically low short interest as a profound institutional respect for Elon Musk's historical capacity for abrupt, paradigm-shifting narrative reversals. Wall Street has learned its lesson the hard way. Shorting Tesla purely on legacy fundamental metrics has historically been an absolute graveyard for macro hedge funds. Every single time the traditional automotive metric suggests the company is massively overvalued and ripe for a correction, management pulls a technological rabbit out of the hat.
Right, the magical rabbit.
Whether it is an unexpected gigafactory production ramp, a sudden breakthrough in autonomous routing architecture, or a masterful capital raise at the absolute top of the market, they find a way to shift the goalposts. The immense fear of being caught off guard by a sudden technological leap keeps the institutional short sellers permanently on the sidelines.
I deeply understand the historical trauma of the short sellers. I really do. But I flip this exact data point into a massive asymmetric risk factor. Because the short interest is so incredibly low at 1.85%, it means there is absolutely no structural short squeeze setup in the market.
Explain the specific mechanics of why the absence of a short squeeze matters to the downside.
When a heavily shorted stock begins to drop rapidly, the short sellers eventually have to buy back the stock in the open market to cover their borrowed positions and lock in their profits. That forced mechanical buying provides a natural cushion. It creates a synthetic floor that slows the velocity of the descent. Because there is practically zero short interest in Tesla right now, if the AI narrative finally cracks, and if that 200-day moving average at $393 breaks, there is zero latent buying power from forced bear covering to cushion the fall. There is no safety net.
But that theory assumes the long holders, the institutional investors currently holding the stock, will all rush for the exit simultaneously.
The positioning data suggests they absolutely might. The sentiment structure shows a highly polarized narrative with very limited outright bearish positioning. This means the people holding the stock are divided into two camps: absolute retail zealots and institutional tactical renters. The massive institutional ownership base has shifted away from deep, religious conviction in the fundamental automotive story. They are now just tactical renters, holding the stock purely for the momentum of the AI and robotics narrative. Renters do not hold through structural technical breakdowns. If the geometric trend breaks, the renters will evict themselves immediately to protect their quarterly performance metrics.
Well, to truly understand why the market remains so fundamentally terrified of shorting a company with shrinking revenues, and to grasp the psychological grip this specific asset has on the institutional mindset, we must move to slide 6. We need to unpack the historical trauma and triumphs of Tesla's 5-cycle narrative history. Because, this isn't just a traditional equity. It is a cyclical, multi-year storytelling engine.
The history is vital to understanding the current vulnerability. The data sheet explicitly outlines a 5-cycle narrative history. We can be brief on cycle 1, the electric revolution, up to 2018, where they simply proved electric vehicles were commercially viable against internal combustion engines. And cycle 2, spanning 2019 to 2021, which was purely about scaling the mass market Model 3, achieving standard gap profitability, and gaining formal inclusion into the S&P 500 index. Those early cycles were built on tangible, measurable automotive manufacturing milestones.
But cycle 3 is where the institutional psychology truly fractured. This was the era dubbed the Musk distraction crash, spanning 2022 to 2023.
Yes, and I want to dwell heavily on cycle 3 because it proves a critical mathematical point. This stock is not immune to financial gravity. During that specific period, the stock suffered a brutal, unrelenting 74% drawdown, plummeting all the way down to $108 per share.
It was a bloodbath.
Why did that happen? It wasn't just macroeconomic headwinds or rising interest rates. It was a fundamental crisis of trust. The acquisition of Twitter, the massive uncoordinated liquidations of Tesla shares by the CEO to fund that acquisition, and the resulting corporate governance risk temporarily broke the broader market's faith in leadership. It proved definitively that when the core narrative sours and when the market genuinely believes executive focus has drifted away from operations, the stock can and will fully decouple from its premium valuation. The floor drops out entirely.
I concede that the 74% drawdown was a severe, agonizing test of the core shareholder base. However, the sheer violence of the subsequent rebound is exactly what created the 1.85% short interest we discussed on slide 5. Cycle 4, stretching from 2023 through the end of 2025, was the AI, full self-driving, and Optimus re-rating era. This was perhaps the most spectacular narrative pivot in modern megacap financial history. Management successfully rebranded the entire enterprise. They explicitly instructed the market to stop valuing them as a capital-intensive car maker and to start valuing them as a high-margin AI compute platform.
And the market swallowed it hook, line, and sinker, completely ignoring the deteriorating automotive margins?
They accepted it because the underlying vision is incredibly compelling. This specific re-rating produced an astonishing 354% rally, taking the stock from that $108 trough all the way to the December 2025 peak of nearly $490. Furthermore, this rally was heavily buoyed by the prospect of a newly Trump-aligned regulatory environment. Investors interpreted the CEO's political alignment as a massive, tangible tailwind for clearing the bureaucratic hurdles facing autonomous vehicle deployment. The market effectively priced in a future where the regulatory red tape, which historically prevented the rollout of commercial robotaxi fleets, would be systematically slashed by federal agencies.
Which brings us directly to our current reality. Cycle 5. The slide aptly titles this cycle, The Reckoning.
The Reckoning.
Yes, the era of pricing in limitless autonomous potential without demanding tangible cash-flowing proof is over. The reckoning is here because that exact political posture that drove the 2025 peak has shifted dynamically. In key global EV markets like Europe and China, the CEO's intense political alignment has transitioned from a perceived regulatory asset into a tangible consumer brand liability. We are seeing active consumer resistance in the core automotive segment tied directly to public posture. Furthermore, the broader market is finally demanding a mathematical reconciliation between the utopian AI promises made at the peak of 2025 and the harsh, margin-compressed operational reality of 2026.
Okay, I will concede that Cycle 5 fundamentally demands proof of concept. The market's patience for pre-revenue prototypes is not infinite, and the transition from narrative stagecraft to actual free cash flow must begin. This leads us directly to our final analytical framework on slide 7. We need to determine exactly what tangible evidence the market requires to prevent a full-scale cycle collapse and what specific conditions would signal a resumption of the historical bull trend.
Let's actually look at the scorecard on slide 7 for a minute because, frankly, it's a bloodbath. Out of the 6 fundamental conditions you would demand to see before buying a hypergrowth stock, almost none are met. Let's walk through the mechanics. Condition 1. Revenue returns to sustained year-over-year growth. Not met. As we established, we are contracting at negative 3.1%. Condition 2. Operating margin recovers toward high single digits. Not met. We are stalled at 4.6%. Condition 3. Robotaxi or FSD monetization becomes real. Not met. The software remains entirely pre-revenue in terms of a standalone commercial fleet. Condition 5. The stock reclaims and holds firmly above the 50-day moving average. Not met. We are trapped below it at $395. Condition 6. Valuation becomes more reasonable or core earnings inflect sharply upward. Absolutely not met when trading at 337 times trailing earnings.
You deliberately skipped condition 4.
I did. Condition 4 states energy storage scales enough to matter at the consolidated company level. The datasheet scores this as partially met because the Megapack commercial deployments are indeed exceeding 100% year-over-year growth. So, out of 6 strict institutional buy conditions, we have exactly half of one condition partially met. You cannot build a durable $1.5 trillion investment thesis on a 0.5 out of 6 score. It is mathematically indefensible.
The scoreboard you just read reflects the past and the present. But equity markets are inherently forward-looking discounting mechanisms. We must look at the bull catalysts outlined on this slide, which are the specific upside triggers required to immediately change the thesis, satisfy those missing conditions, and justify the multiple. The primary overriding catalyst is a real commercial Robotaxi launch in Austin, and the criteria listed here are incredibly strict. We are not talking about another carefully choreographed low-speed prototype demo on a closed Hollywood studio lot. We need verifiable, geo-fenced fleet economics. We need to see real civilian passengers paying real digital fares in a complex, undefined urban environment. If that specific mechanical milestone occurs in late 2026, the entire 337 times valuation multiple is instantly justified as a software platform.
The word "if" is doing a monumental amount of heavy lifting in that sentence.
Maybe, but furthermore, we have the catalyst of Optimus moving into visible, large-scale factory deployment. If we see hundreds of autonomous humanoids actively displacing human labor costs on the assembly lines in the Texas or Berlin gigafactories, the massive robotics option value currently priced into the stock crystallizes into a tangible margin benefit. Finally, an external original equipment manufacturer licensing deal for full self-driving would instantly validate the software stack's commercial transferability. If a legacy automaker pays to install Tesla's neural net architecture in their own fleet, it creates a massive, nearly 100% margin recurring revenue stream.
Those are wonderful, highly optimistic scenarios, but as analysts, we have to weigh them against the bear catalysts. And given the current downward velocity of the geometric trend, these bear triggers are highly probable. The downside risks are immediate. Another weak quarter of top-line revenue contraction will shatter the hypergrowth illusion entirely, forcing institutional growth funds to liquidate. Further margin erosion stemming from Cybertruck manufacturing inefficiencies or the necessity of further defensive EV price cuts to fend off BYD will trigger immediate downward earnings revisions from Wall Street analysts. But the single most critical bear catalyst is any significant delay in that Austin Robotaxi rollout.
Right, the timeline risk again.
Exactly. If late 2026 arrives and there is still no meaningful, cash-flowing commercial deployment, narrative fatigue will absolutely set in. Institutional investors will suddenly realize that Optimus is years away from economic relevance, that Level 5 autonomy is still scientifically unproven in chaotic edge cases, and that they are holding a shrinking margin-compressed car company at 300 times earnings. The Cisco 2000 trap springs shut.
So this leaves us with the ultimate portfolio management question, which the source material demands we answer. How does capital actually position itself against this incredibly binary, high-stakes setup?
For me, looking purely at the mechanics of risk versus reward, the strategic bottom line mandates a strict watch list-only approach. You simply do not deploy core portfolio capital into an asset resting dangerously on its 200-day moving average, possessing actively deteriorating fundamentals, and scoring a dismal 0.5 out of 6 on basic buy conditions. The mathematical risk trigger is clear. A decisive, high-volume technical break below the 200-day moving average, completely unaccompanied by any fundamental operational improvement, mandates stepping away from the asset entirely. You let the falling knife hit the floor.
I view the risk profile through a fundamentally different lens. I actively defend a 1% to 2% portfolio allocation specifically for high-risk, high-reward growth mandates. When you have an enterprise backed by a pristine balance sheet holding $44 billion in cash, the immediate downside solvency risk is virtually zero. This unique financial structure makes the equity effectively function as a long-dated, deep out-of-the-money call option on multiple paradigm-shifting futures, namely global autonomous transport, generalized humanoid labor, and grid-scale energy storage.
A strictly managed 1% allocation is a relatively cheap premium to pay for an option on a technological future that literally no other company on Earth has the manufacturing scale or data mode to achieve, provided it is managed with ruthless risk control.
A call option priced at $1.48 trillion is not cheap, no matter how much cash they hold in the treasury. It requires absolute perfection to break even.
As we synthesize the entirety of today's slide deck, the vast structural chasm remains unresolved. On one side of the ledger, we have Tesla's fortress-like balance sheet, its unprecedented strategic optionality in AI and robotics, and its historically unmatched narrative gravity. On the exact opposite side, we have immediate, measurable, and severe fundamental deterioration in the core automotive operations that pay the bills today.
It is truly the ultimate test of modern market psychology. Will this specific era resolve like Cisco in the year 2000, where the company was strategically brilliant and built the correct infrastructure, but the stock still suffered a lost decade due to extreme overvaluation? Or will it resolve like Amazon transitioning to AWS, where the current margin pain and massive capital expenditures are merely the necessary foundational costs of building the infrastructure for a vastly more profitable software-driven future?
Well, we leave it to the listener to decide which historical analog will ultimately prevail and to watch the technical charts closely to see whether that critical 200-day moving average can hold the immense weight of the market's future expectations. This is the Research Desk officially signing off.